Thank you, Simon, and thanks for the intro. So, as Simon mentioned, my name is Ryan Basdeo. I'm a portfolio manager at OneInvest. The title for today's presentation is, as it states, portfolio positioning through the economic cycle. What I would hope to leave you all with today is some idea of how to position or tilt your portfolio through different parts of an economic cycle. With that said, we would first need to understand what is an economic cycle. Following that, we would then need to understand how do asset classes perform through different parts of this economic cycle. And then once we've built this base knowledge, we would try to make use of ETFs to provide some overlay or to be used as proxies for these different asset classes. And lastly, I'm sure the last bit of the agenda will touch on these trending words that I'm sure we all have heard of, a U-shaped or a V-shaped recovery. I'll try to better define that for us. It is a short agenda, so as Simon mentioned, please feel free to post any questions, and we'll get to them at the end of this prezo. Okay, so let's get stuck into it. The economic cycle. So, what is an economic cycle? So all economies move through periods of peaks and troughs, so periods of expansion, periods of contraction. An economic cycle is basically this fluctuation or this movement from the peak of economic growth to the next low point of economic growth. And as you know, that these economic growth is impacted by many factors, some of this being employment, consumption, consumer and business confidence, interest rates, and as we've seen recently, a healthcare crisis can significantly steer the direction of economic growth. And these things are all important to us. Why? Because our portfolios, our investments, our pension funds are all underlined by financial market instruments. And financial market instruments are all linked or correlated to economic growth. So if we think of this chart or this graph as our economic cycle, it basically on the far left has a trough or the bottom of the cycle or bottom turning point, and then that trends up towards the middle of the chart there, which is the peak or the high turning point. If we start on the far left, this first phase would be called a recovery phase. This is a phase where we think of the worst being behind us, where there's expansionary monetary and fiscal policy coming through from government and central banks. We start to see the bottoming out of property prices. We start to see stock markets becoming a lot more attractive. Interest rates start to fall or low at this point, which encourages spending. This then transcends us into a early growth phase. In this phase, interest rates will remain low. Consumers and businesses have managed to borrow at these low rates and consume or spend in the economy or reinvest in their businesses. We've seen economic indicators such as retail sales or productivity improving. We see company profits improving. All of these factors drive strong stock market and commodity prices during this phase. We would then push on to a late growth or a maturity phase. And during this phase, we start to see a rise in inflation. Rise in inflation due to all this demand that has come through in the economy. Central banks start to think about of increasing interest rates to curb this growth in inflation at this point. We start to see company profits starting to peak, stock market prices start to peak, commodity prices start to peak at this phase. Property, which would have been a lagger in the cycle relative to other asset classes, will still continue to rise during this phase in the cycle. This then leads us into the start of a recession. The start of a recession being where we start to see a slowdown in economic growth. sales of company stock or company services start to decrease. They start having lots of inventory on hand. Stock market prices start to decline. Inflation will continue to rise during this phase. We start to see the peak of property prices as well during the start of a recession. And lastly, when we're in the thick of a recession or the late stage of a recession, GDP would have reduced significantly, stock market prices would have come down significantly, commodity prices would remain weak, property prices would weaken during this point. And we start to see inflation reaching the peak, which would probably get central reserve banks starting to think about the possibility of reducing interest rates in the near future, mainly as due to inflation reducing, but also trying to stimulate the economy. So I'm just going to pause here for a second, just so that we can all embed this chart in our minds. And ultimately, what we'd like to take out of here is that very bottom turning point on the left, where it is an environment full of stimulus, which then pushes us up to this peak or this high turning point, where the company, where the economy has reached a peak of productivity, and then we need to start thinking about a risk-off environment or going into some safe haven assets. Okay, I'll jump into the next slide, which I thought is a fun way, a bit more interesting way to show how us humans feel throughout a full economic cycle, or what emotions we display. So at the very start, when it's all good things ahead, we all feel optimistic and we feel excited about the future. We invest in risky assets, happy to take on the risk with high rewards expected. This all goes well, and we ride this wave of wealth or growth, and we pile in more into this risky assets as we start harvesting this good return that they've been giving us. Then at the very peak, we become complacent. We feel that we've conquered it all. We've made a lot of money, and we tend to forget about this risk that we've taken that has rewarded us so richly in the past. When markets or the cycle begins to turn, we do start to feel anxious about it, but denial sets in. We don't want to believe it. We reinforce our views that the cycle is going to turn again in our favor. And by then it's generally too late. We panic sell at this very bottom or this turning point where we should start seeing opportunity to actually get back into risk assets. And then the cycle continues on or kicks back up again. Okay, so moving on to more fun stuff. How do asset classes perform, or how should we look to allocate to asset classes during different parts of the cycle? So if we begin again with my graph of the cycle, at this first stage, this would be a late stage in the recession, just before we reach the bottom turning point. At this point, one should have significantly reduced their exposure to risk assets, so down-weighted stocks and commodities, and gone into safer haven assets such as bonds or cash. The idea behind bonds in this environment would be we should be entering into a reduction or a low interest rate environment, which should spruce up capital returns on bonds. Then at the next turning point, or the low turning point, where we start to go into a recovery phase, we would then start adding on or taking on some risk in the portfolios and start adding to stocks. We've seen during this phase, the financial sector, for example, starts to harvest some good returns at this turning point. Then moving on into strong growth phases, we then continue our risk-on mentality. We start adding back into stocks, as well as adding into commodities, which tend to perform very well during this strong push up in the economy. At our high turning point, we should then start harvesting some of this profit that we've incurred from having stocks and commodities in our portfolios, start to reduce our exposure to stocks. Commodities generally still tend to perform right up until this peak, so I would still hold commodities in the portfolio at this point. And then lastly, when the cycle does actually turn, when the tide does turn, we should be significantly reduce our exposure to risk assets and going back into safe haven assets such as health or defensive stocks such as health or cash and bonds. So the key takeout from the slide would be the idea of transitioning between risky assets and safe haven assets as we reach these two turning points in an economic cycle. Okay, so moving on to how would we overlay ETFs to represent these different asset classes. I'm going to overlay the One Invest range of ETFs because the range does significantly cover a lot of these asset classes. So if we think of a portfolio where we're looking to be long bonds, One Invest does have a SA sovereign bond ETF, which would be a good proxy for bonds at this point in the cycle. When we look to take on significantly more risk, I would introduce an ETF such as the Swiss 40 ETF, which does have, due to the methodology, it does have a slight skew towards the financial sector. The SA property ETF would be another good one to bring into our portfolio at this point. And then moving on to that strong growth phase, we've also seen technology perform very well during this phase. One Invest has an S&P 500 Infotech ETF, which basically gives you exposure to all the tech stock listed in the S&P 500 index. And the broad commodity range that One Invest has to offer would be something that we would add into the portfolios at this stage. The commodity range would cover platinum, palladium, rhodium, and gold. And as we reach that peak, we would remain in commodities, but look to reduce our exposure to the equity of the stock ETFs. And then lastly, back into the defensives, the healthcare sector, or basically cash. Okay, so moving on to the last section of the presentation, the U-shape or V-shaped recovery of the economy. So some of the possible, or basically there are many possible scenarios that could play out in the shape of the recovery. Data in hindsight, data can be backfitted to fit many shapes. But there has been consensus around these four shapes, that being a V-shaped, a U-shaped, a W, and an L-shaped recovery. So a V-shaped recovery is where the economy has had a very sharp decline, but government and reserve banks have stepped in with massive stimulus programs. And these stimulus programs are of enough scale to spruce up the economy as sharply as it has fallen. This is all under the assumption that COVID virus infections does not kick back in. We've got it all under control, and we see this very sharp rebound due to all this pent-up demand in the economy. The next shape, which is what I think is the base case for South Africa, is a U-shaped recovery. So it does look very similar to a V-shaped recovery. However, that bottoming or getting out of that bottom is a lot more sluggish and does take a lot longer for us to then start trekking back up to those peaks. And this is generally due to governments of these economies not having enough power behind their stimulus packages to spruce the economy back up and to drive this and to get this demand back into the economy and to get companies reinvesting and people consuming again to push the economic growth. So then the next shape we'll discuss is the W shape, which I think is the worst case scenario. It's also known as the double dip recession. So this is where lockdowns cease to exist, and strong second wave of the economy, a second wave of infections coming through, which then pushes us back into a recession. And this second wave of infections is as strong as the first wave, and we struggle to then get back up to those previous highs, but we eventually do. So it's basically a two V shapes in the shape of the growth cycle. And lastly, we have the L shape, which is what's generally labeled as the black swan event, which is basically a rare event or event that hasn't occurred previously. And this is where there's been permanent damage to an economy due to significant or long periods of lockdown. This is where the impact spreads throughout our financial sector. We start seeing a lot of credit defaults in the market. And the economy takes a very, very long time to get back up again. Okay, lastly, if I recap on some of the topics that I've introduced today, I guess in summary, one of the key points is we need to be very familiar, and we need to know the drivers of an economic cycle and the different phases in them. I would think this is where a portfolio manager or a fund manager should have lots of skill, or a good portfolio manager should have lots of skill in being able to identify these different phases and tilt portfolios throughout these different phases. As well as highlighted that ETFs can serve as a very efficient vehicle to give us exposure to these different asset classes. And on the shapes of economic recovery, as I've highlighted, there's many shapes that do exist. I do believe that apologies, my dogs are crazy. I do believe that the best case for South Africa is the U-shaped shape of recovery, and this is largely due to, I think we will get carried out by some of the global demand and the global growth that's out there. If we think of the South African economy, the majority of earnings that feed through on JSE listed stocks is earned globally, and global economies do have strong support systems that is driving some of the recovery at the moment. I think largely overall we should focus on our long-term investment goals, our long-term investment positionings, and during these bottoms look for opportunities to get back into risky assets. I think probably something that I haven't touched on earlier is allocating to foreign assets during this part of the cycle. If we think of foreign exposure, there's that additional complexity of currency that's added to it. If we look at the JSE All Share, removing currency out of the equation, or the weakness of the rand out of the equation, over the last 5 to 7 years, our returns are very much negative. Our returns are very much negative. Apologies, I just want to mute my dogs for a second.
Sure thing.
Sorry about that. So yeah, if we think of currency, currency is one of the most largely traded markets in the world. It's one of the most liquid markets in the world, and it's generally the market that would tend to react before any other stock market, fixed income market, property market, reacts. So the currency returns tend to be somewhat uncorrelated at times to this economic cycle. With all that said, If we look at the MSCI World Index during this large period of March, or this large drawdown in March, in rand terms, that index actually slightly outperformed or delivered positive returns. All of this information now tells us that we should have a constant allocation to foreign assets throughout this investment cycle, and by that I would look to have a constant allocation of around 20% in the portfolio throughout the economic cycle. And lastly, I'd just like to highlight the full range of the One Invest ETFs that's available to help construct this portfolio, to help give asset class exposure in your portfolios throughout the economic cycle. This range spans from local ETFs that covers both property, equity, and bonds, as well as global ETFs, which gives you exposure to global property, global equity or stock market indices, global bonds, as well as the funkier stuff such as your S&P 500 infotech, or the infotech sector. And lastly, the range does cover commodities, and as I mentioned previously, palladium, platinum, gold, and rhodium are all in the One Invest commodity range. Okay, Simon, I think that's it from me.
Cool.
And again, apologies for all the interruptions.
It's our new reality these days. I had someone drilling upstairs for me. Fortunately, I could mute my mic at that point. A couple of questions coming through. The one question is around tax-free, and I can grab the answer there. The question is quite simply, can we do this within a tax-free account? You absolutely can. One proviso, you obviously can't put the commodity ETFs into a tax-free account, but you can certainly transact. And the question was more about, exiting one position and entering another. SARS is quite happy for you to transact within the tax-free account. The issue is money flowing in, money flowing out, but as long as we are sort of staying within, there's no problem. And you can't put commodity ETFs or any ETNs into your tax-free account. Ryan, one question coming from a couple of people, looking at those stages 1 to 6 of the cycle, where is your best assessment of where globally and locally we are sitting? Are we sort of stage 2? Have we perhaps moved into stage 3 already?
Simon, my best estimate will be that we currently still at stage 2. Mm-hmm. I think that, the economies, even globally, they have peaked quite quickly, or gone back up quite quickly to this peak, which the sentiment out there right now is that it was too fast, too soon. It is not giving anyone much comfort, and we could possibly be testing these bottoms again. So I would say that we are still firmly in stage 2. Possibly once we start to see the economy recover, and that we do have firm control over COVID, towards the latter part of this year, we could start entering a stage 3.
Gotcha. I think that ties in, I think, with where I'm thinking at the moment, and what my thinking is. The question coming through is taking into account what the market is looking. It's looking very V-shaped from the market perspective, but from Main Street perspective, it's looking a lot more W-shaped. Ryan, that ties in with what you just said a moment ago. And the question is sort of what's driving that disconnect? And I suppose, Ryan, there's 2 plays here. One is that the market and the economy aren't always in sync, but more than that, we've had significant stimulus coming out of the US Federal Reserve. We're seeing it in Europe. Our own Reserve Bank has just announced that they've done some 10 billion rand of bond buying in the secondary market, and that helps, in a sense, distort that relationship between what we would expect to see from the fundamentals relative to the share prices.
Yeah, 100%, Simon. And markets, especially in these times of turmoil or high volatility, markets tend to react very quickly. Markets should be forward-looking, and generally, portfolio managers' views are discounted for 4 to 5 years in the future. But yes, stuff like the currency effect in our local markets as well can very much drive this disconnect between the economic cycle or the health of the economy versus where the stock market is actually pricing it in.
Mark, you're asking about fees on the ETF. So there's going to be three fees. One is the transaction when you buy and sell. The other is depending on where you're buying and selling. There might also be a platform fee. The third fee is the total expense ratio. And having a quick look down at the One Invest, they range from 0.25 on the gold ETF up to rhodium being more expensive at the 0.75, but most of them around about the sort of 0.3%. And that is an annualized fee and is typically taken out of the dividends that are paid. Obviously, commodities don't pay dividends, so it's taken out of the price to a degree. Shabir, you're asking about renewable energy ETFs available in South Africa. Shabir, we don't have any in South Africa. We have very few. In fact, we have no pure renewable companies on the JSE, albeit we do have some, but they're more in the construction space, RABEX, consolidated infrastructure, and the like. But Addition Naidu from WebTrader will be doing this webcast in 2 weeks' time, and he will be looking at US ETFs, and I'll ask him to look for some renewable in that space there as well. What other questions coming through? We've taken those, and those pretty much. So they've all been around where we are on the stage, and we've covered that already with Ryan. Ryan, the question is if you could shift back to the slide with the ETFs listed on as per the different stages. I think it was your last or second to last
this
slide.
One. Simon, is it this one here, or are we talking about the product range?
No, that one's perfect. That's it there. Sorry, I wasn't paying attention to that.
No problem.
Asking about robotic ETFs again, South Africa, no. But I will add that onto Addition's list. He's going to be doing for us in 2 weeks. So what will that be? The 19th of June Addition, and he's going to be looking at offshore ETFs available in the WebTrader platform. Ryan, a question coming through.
Simon, and probably.
Yeah, Ryan, jump in. Sorry
to interrupt. I mean, probably something interesting to mention. That on this robotics topic, or more so on the entire technology sector topic. If we look at both global and local stock market returns over the last 5 years, if we remove the tech sector stocks from it, so in the US, for example, your large Apple and Google stocks, and Naspers on the local side, we actually go into a negative return for that period. So it just highlights returns have been in the tech sectors.
Yeah, and someone's also just reminded me, was it 2 weeks ago when I looked at the tech ETFs available on the JSE? There are three. There's the Satrix Nasdaq, there's the Signia Fourth Industrial, and then there's the One Invest, which is the S&P tech. So they take the S&P 500 and they pull out the tech stocks from it, and there will be obviously some robotic within that, not specialized towards, but there's going to be some of those sort of more niche areas. And certainly of those three tech, I much preferred the One Invest because it was pure tech. Nasdaq is about half tech. The Fourth Industrial is only about a third of it is actually tech. If you want a pure tech play, it's that S&P, because they look at the S&P 500, they pull out, I think it's about 78 stocks that are tech focused. So you get a 100% tech focused play. Tobocho, you're asking if you have an OST account, cheaper to buy ETFs directly from OST than buying from another platform. The transaction fees for the ETFs are going to be the same regardless of where you're doing. Obviously, different platforms charge different fees, but you're not going to pay a higher TER. You're not going to pay anything different. There's nothing to be gained from buying directly. Online share trading does occasionally, usually towards the end of the tax year, as we head into the tax-free season. They'll do some specials with the One Invest, but other than that, the difference is relatively mute. Ryan, a question coming through around currency, and the point is, at the moment, we're seeing a stronger ZAR down at 1690 last I saw earlier this morning.
Yeah.
Should we, in the short term, sort of try and manage the ZAR, or do we stand back and say, over the long term, the rand will weaken against the US dollar, and ultimately it will shake out for a long-term investor to our benefit?
Yes, Simon. So I definitely in the camp of that longer term view, and it's a general view across all emerging markets that emerging markets currencies should generally be weaker or perform weaker relative to developed market currencies. So yes, I would stand back and take that longer term view that currency weakness will come back into the economy.
Howie, you're saying, given the healthcare demand drivers over the short term, should these equities and ETFs not have a place in one's stage two? Two answers to that. And again, I did a presentation on offshore healthcare ETFs earlier in May. And you can go have a look at what the options are out of New York, nothing in South Africa. But secondly to that is go have a look at Mediclinic, Netcare, Life Healthcare results. They're actually struggling under pandemic, largely because hotels are there's no A&E, there's little elective surgery happening, so as they wait for the sort of the wave of COVID-19 patients to come. So truthfully, healthcare in terms of hospitals are struggling. Drug manufacturers, mixed bunch. Medical suppliers also struggling because the hospital groups are holding off right now on equipment, again, as they sort of batten down the hatches for the wave of COVID-19 patients. Ladies and gents, we have hit our half hour. I'm going to park it there. Video will be on the YouTube channel, let's say early afternoon. Go to YouTube, search Standard Online Share Trading. We will upload it there. I thank all of you for your time. Ryan, I really appreciate your time and the presentation this morning.
Thanks a lot, guys. Appreciate it.
Everyone, have a good weekend. Stay safe. Remember, wash your hands, wear your mask when you head out. Cheers all.
Cheers. Bye-bye.